Hello everyone. I am Dr. Mehak and I am from Zadis University, Pakistan. So today, the topic I would be presenting is vector model, testing of Fama and French six-vector model in Pakistan. First of all, I would like to give a brief introduction about what is this model. We know that we are investing in different markets. Stock market is is the most prominent financial market for any economy. So whenever we are investing, there are different behaviors. Sometimes investors are investing rationally, irrationally. Sometimes they are just following the herd. Sometimes they are just following experience. For example, in Pakistan, there is a Lehman community. And everyone from that community is investing in stock market, and mainly they are investing on the basis of their experience. Other than that, if we move forward, for example, we know that we have different investment companies. Those companies are basically investing on the basis of value, on the basis of style investing, sector investing, and sometimes they are calling these stress testing. So when we say about factor models, we are seeing that these are the models which are, which are introduced on the basis of different kinds of factor investing, style investing. Now, what basically I'm doing in this research is, in this paper is, that we are going to observe, we are going to see that how these models are going to document or explain the anomalies which are existing in the stock market. Now, if we talk about the anomalies, we know anomalies are the abnormal patterns. It can be anywhere. But if we talk about anomalies in the stock market, so these are the basically deviations. These are the observations which are the assets returns which are deviating from what a model can explain. So for example, if we say stock market, all these models, for example, the six-factor model, they say that the markets are efficient and their model can explain all the anomalies or abnormal patterns which are existing in the market. But these anomalies are the potholes in these markets. If this model is not able to explain these anomalies, it means that model is not efficient. And these anomalies are actually very important for investment decision making because these anomalies can help the investor how you can make an investment decision. If an anomaly is very well documented in any stock market, for example, size is an anomaly. We believe that small size companies are able to provide better future returns. If this anomaly is very well documented in any economy, and if this model can explain this anomaly, then by using this model, we can make the best out of that anomaly because this model can provide us a better expected return in which with reduced pricing errors. So this is my overall research. Now I will move with introduction. So we know that investment is pretty much a common, we can say scenario or common information, but sometimes we lack how to make investment decision out of it. So it all started with the theory of Markowitz on asset allocation and asset returns, when they said that, if an investor is willing to take an extra unit of risk, then obviously for bearing that extra unit of risk, he or she will demand extra unit of return. When this observation came into existence, then many researchers started working on the risk, like which kind of risk is the most significant risk and which risk brings the most variation in the stock return. So with this, Sharp came up with a model which is capital asset pricing model. Sharp said that market risk, which is known as beta, is the most prominent risk which explains most of the significant variation in the stock returns. Many authors tested this model, many accepted and many rejected it. Then we have Fama. Fama said this model has some limitations because there are inefficiencies in the market and there are different factors which are actually better able to explain the stock returns, but short model is unable to explain this. So next to CAPM, arbitrage pricing theory came into existence by Ross. Ross said that no, it's not just fundamentals of the company, it's not just market factors. There are different macroeconomic factors which brings variation in the stock returns. For example, interest rate, policy rate, GDP, inflation, CPI. These are the factors which we need to consider while calculating the portfolio returns or asset returns or stock returns. After that, many researchers said that besides market risk, there are different factors which contribute in the expected returns. For example, it can be related to pricing factors, it can be related to size factor, it can be related to the leverage of the company. While considering all these reservations, Fama French came up with a three-factor model, and Fama French said that besides market risk, value factor and size factor are the most prominent factors which explain these stock returns. Then we have Carhart. Carhart said no, momentum factor is the another factor which brings the variation in these stock returns. After this, again, Fama French extended their previous model and they came up with a five-factor model in which they included investment and profitability factor. Then Fama French again introduced a new model by extending their previous model. They came up with a six-factor model and they said, we think that size, value, market, profitability, investment, and momentum. These are the factors which bring most of the variation in these stock returns. They also introduced an alternative six-factor model in which they replaced their operating profitability with cash profitability. So if we look at the Pakistan, then this study is an out-of-sample test of Fama French 6 and alternate six-factor model. Basically, if we look at all the asset pricing studies, mostly all the studies are on the US market or UK market or developed market. And if we move to emerging markets, then most of the studies are basically on China and India, because China and India have the two, they have the most highest weightage on emerging market index of MSCI. So, since I have ties with Pakistan and we do like research in asset pricing in Pakistan, so I want you to see how these models are performing in the Pakistani market. And in the Pakistani market, most of the models which are tested are Fama French three-factor model. There was a study in 2021 by Ali who tested Fama French five-factor model. But I wanted to test further that how these other two models, which have been recently introduced and they have been recently accepted in different markets, how they are performing in Pakistani stock market. For knowing how these models are performing in the market, basically, since I said that we are going to see how these models are going to capture the abnormal factors which are existing in this market. So initially, I replicated 52 anomalies in this market, but I have taken only 11 anomalies in the sample. These are the anomalies which are significant. They actually passed a cutoff criteria of 1.960 T statistics. So I have taken only 11 significant anomalies. So we are going to see how these models are going to explain these anomalies which are significant for the Pakistani stock market. So I don't know if you know or know, Pakistani stock market was previously an emerging market, but then MSI reclassified it as a frontier market. But yet Pakistani stock market has characteristics which are similar to emerging market. Because it's a highly volatile market. So if investors want to enjoy spills and thrills, then obviously they can invest in it, because if they are going to bear high risk, they will enjoy higher returns as well. Other than that, this market has higher trading, high volume, low market capitalization, and this market is mainly includes small companies, and small companies are pretty risky companies. So this market is very essential for the local and foreign investors. By the way, previously, a few years back, due to political instability, the foreign ownership of shares went to 0% in Pakistani stock market, but now it's again 14.35%. So we know that this market is very important for both local and foreign investors. Okay, if you look at the literature review, then we can see here that there are different anomalies, there are different factors which have been proven. But if you will notice one thing, everywhere it will be written U.S. market. Since I said that all the asset pricing studies are mainly on U.S. market, so if you look at this literature review, Statman said that book to market equity and U.S. stock returns has a positive relationship. Then there are different authors who said that size is the main factor. Some said no, book to market equity ratio is the very important factor. Some said leverage is the very important factor. Some said earning to price ratio is an important factor. Then some said that momentum, by the way, momentum is something that we know, for example, if a firm has previously performed very well, if it has been a winner in the past, then we say that this company or this firm, this stock will keep outperforming in the future as well. So most of the researchers say that this momentum thing is very important. Then we know that we have investment and profitability factors which we think are very important. We know that Fama French is a very prominent name in asset pricing. But besides Fama French, there are many other authors who are coming up with very noticeable empirical models. For example, one we have two-factor model from Hu et al. And this model is now widely tested in US market and in developed markets. And this model is again based on market, size, profitability, and investment factors. But their profitability and investment factor is different from the profitability and investment factors of Fama in French. Then we have another prominent model by Stenborg and Yuan. They said that mispricing factors are the most important factors for pricing any asset. So yes, we can see that the quest of finding a suitable model is not over. People keep testing these models, they keep coming up with new models because we know that markets are not efficient, and with the passage of time, market behavior keeps changing. So we are always in need of finding the best model which can actually tell us how we can make the best out of our investment.
Can I just?
Yeah. Oh, sorry. So if I look at the methodology, so all these data is collected from Thomson Reuters, and the data is from 2000 to 2017. And I have used MATLAB. Sorry, I have used MATLAB to do all the analysis. I think I should better come on my analysis because that is important. Okay, I have used different filtration methods and different cleaning procedures. If I come at my results and the time is very low, we can see here the yellow factors that market, size factor, and value factor. We can see they are significant factors, and these are the effects which are present in the Pakistani stock market. By size, we mean we can invest in small companies and we can outperform. By HML, we means we can invest in the value stock and we can outperform. But if we see the profitability factor is negative, which means low profitable stocks are actually providing higher returns in the Pakistani stock market. Though in US stock market, higher profitable stocks are actually providing higher returns. So moving on to next, these are some of the anomalies. These are all significant anomalies. Next here, we can see the correlation between the factors. Okay, one thing which is to be noticed here is that all the factors from one model have correlation less than 0.7, which means there is no multipolarity issue in the factors of these models. Okay, so main results are here. If we see the p-value here, the GRS plus p-value, we can see that all the values are less than 0.05, which means none of the two models are the complete description of the anomalous returns. And if we look at the overall results here, then on the basis of different metrics, we can say that Fama French 6-factor model is somewhat better at explaining the anomalous return patterns in the Pakistani stock market. But again, the p-value was less than 0.05, which meant that these models are not providing complete description of anomalous patterns. And if we look at the factor redundancy test, which means that these factors are not actually suitable for this market, we can see this intercept value, this first column. We can see that market and size factors, they have t-statistics about 1.96, which means these factors do have some unique information which cannot be captured by the other remaining factors. But if we look at the other remaining factors, all t-statistics are less than 1.96, which means these factors are actually not important for the Pakistani stock market. And if I come back to anomalous return factors, where I tested that whether these models are able to explain the anomalous return factors, that yes, I saw that all the p-values were less than 0.05. It means these factors which are included in 6-factor and alternate 6-factor model, they are redundant for Pakistani stock market. It means we should search for a better model which can actually explain the anomalous return patterns in the Pakistani stock market.
That's great. Thank you so much for taking us at that time.